Our next speaker is Marie Dumas, the Global Head of Fixed Income Solutions at Amundi Asset Management. He'll be talking about their approach to factor investing within fixed income.
Thank you for the introduction, Ray. So the topic we'll present to you today is about factor investing in fixed income. So we will try to see what it represents in the new investment world, I would say, how we can use it for sovereign bond investment and also for corporate bond investment, where I would say the factor investing is probably more accurate. And to finish, I will show how we can combine factors to use a multi-factor technique or multi-factor strategy. Clearly, the first important thing is to know what we think about when we are talking about factor investing compared to the traditional way of building an investment strategy, and particularly in fixed income. The challenge of the factor investing is to identify alternative factors, the one which can change a little bit the way to build portfolio compared to the traditional way of splitting alpha and beta strategy. The factors are in fact some alternative beta that we define on an ex-ante basis, and that we can after catch the trends of the market and also identify some behavioral bias in the fixed income market. Of course, it started a long time ago in equity investments, but a lot of new developments came over the last years to adapt it to equity long short, but also to fixed income and credit, and also to cross asset. That's where you found a lot of strategies named alternative risk premium strategy, for example, which are based on these alternative factors that the quant research from asset management firms, but also from institutional investors can identify. What is important to notice is that factor investing is not about drawdown management or about pure alpha catching. It's about achieving a long-term outperformance by strategic allocation which is based on those alternative factors. The most important thing and the best thing we can bring with factor investing technique is the clarity and transparency of the portfolio construction. And the fact is that with those factors, we aim at enhancing diversification in the portfolio, thanks to the low correlation of these alternative factors with the traditional active strategies, and especially in fixed income, for example, the key point is to be able to build a strategy which is lowly correlated to, for example, duration or credit beta. That's important. Or if it's correlated, the important is to know how this factor behave alongside with the traditional beta. In fact, that's this transparency which is important to better adapt your portfolio. Of course, there's heavy research to run before launching such strategies, because you have to identify the factors to be sure that these factors are consistent over time, that they are not just a recombination of traditional factors, and because at the end it will be a sort of traditional strategy just repacked. So we do not look at marketing factors, but clearly at alternative ones. And it is important thereafter, if you combine your different alternative factors, to know how they react with each other. That's a really important thing, which will enable us to build a strategy where the tail risk is under control and where we know that the factors are significant and shows a statistical likelihood. So factor investing is not a sort of magical pot. You have to control also your risk through traditional factors when you do so. You have to, that's what I called the transparency effect, that knowing how your alternative factors are correlated with duration, with credit beta, with liquidity, which are the traditional factors. And thanks to that, you can have a well-structured portfolio. So to go into real world, it is interesting to see how we can adapt it and use this technique, for example, sovereign bond investment. Because in fact, traditional factors are very strong in sovereign bond investors. You know that we can represent the interest rate risk framework with the traditional duration, curve, and butterfly effect. So that's important to notice that with the traditional, for example, component principal and principal component analysis, we can catch a large part of the volatility of the sovereign bond market. So it's not so easy to define alternative factors which are not just a recombination of the traditional one. What we can see and what we did in the past is to identify alternative factors which work quite well in the sovereign bond world. First of all, the carry factor, which can be described in two different factors. The first one, which is a time series carry factor, and the other one, which is a cross-section carry factor. In fact, this signal on the time series one is just a way of catching the roll-down effect on the curve. So that is why the formula, which is in this page 8, shows that it's a duration-adjusted difference between the yield on the 10-year tenor and the yield on the 9-year and 11 months tenor. So that's just the effect on the rate curve of the natural roll down. And you build your carry factor by choosing the bonds which shows the most important roll down over a global universe, a global sovereign bond universe. On the cross-section carry factor, that's a little bit different. That's the whole curve of the fund that you play, and the carry signal is just the 10-year government bond yield minus the 3 months deposit rate. And once again, you rank your different carry signals, and then you pick up the highest carry and you short the lowest carry. So these carry factors are in fact long short. With that, you can show that you catch a special effect on the sovereign bond curve. You can also play what we call the classical momentum. So the momentum factor is like what is done on CTA investing, meaning that you buy the bonds which shows good recent performance, and you short the lowest performers within your universe. And so that's really non-discretionary. You build your momentum factor by being long the performers and short the underperformers. Of course, what is interesting with the CTA, with the momentum factor, is that it's very lowly correlated to the carry factor, and more than that, to the duration traditional factor you see in the sovereign bond world. That's what we have in this slide, where the scatter plot shows that, in fact, the correlation between the return of the strategy, which is here a combination of CTA plus carry models, and the German 10-year yield is very low. So thanks to that, we can see that building such a factor portfolio, alternative factor portfolio in sovereign bond world is not something really related to the duration. And so by using such a strategy, for example, in overlay on top of a traditional bond fund, brings performance, but also and almost diversification. so which is a good thing, and that's the way you use it. And it is very easy to implement because you can do this kind of factors, you can replicate this kind of factors with the use of derivatives such as bond futures and or swap. So that's what we can say about sovereign bond alternative factors. And of course, these kind of factors can also be used in a multi-asset portfolio. More interesting, I would say, than on sovereign bonds, where sometimes the alternative factors are less significant statistically, as I said, because the traditional factors are catching a lot of the volatility of the market and explain quite well the return of sovereign bonds. We can use the factor investing technique in credit market. It is a natural extension of what was done over the last 20 years on the equity market, because in corporate bond market, you are investing in instruments where the specific risk is important. And so you can think that the alternative factors will help us to identify within the specific risk some commonalities. That's what I will present right now in the corporate bond factor investing essentials. First of all, once again, using this factor investing technique is here to describe a systematic approach. A systematic approach which is diversifying existing strategies. Of course, not all the factors are real in the corporate bond world. Very often you will see in literature people talking about the classical factors that we use in equity market, which are value, momentum, quality, or low risk, for example. And we did an important operational research to see among those factors which can really explain the credit returns. So when I talk about credit return, I talk about only the performance coming from the spread variation, so the credit risk premia, not about the interest rate effect. And for the interest rate effect, you can go back to the first section where I describe the alternative factors for sovereign bonds. So really important to rely on factors which are consistent over time and which are statistically significant. What we show from our research is that among classical alternative factors, the most significant one and the one which are showing a real risk premium are the value factor and the momentum factor. For example, the low risk is just a recombination of duration and rating, so credit quality and tenor of maturity. You can see also the alternative factor, which is called size, but which is in fact more a way to be exposed to lower liquidity, meaning less liquid bonds, than really a behavioral bias in the market. So roughly, size is such a recombination of the liquidity factor, which is a traditional one. So let's go in the presentation of these two interesting alternative factors, which are value and momentum. What is important to notice is that factors can be used, alternative factors can be used to explain the market behavior is because now the credit market, globally speaking, in the US, but also in Europe, is quite deep. And that's important because thanks to that, we can have better data, more accuracy in the price, in the prices we contemplate, and it brings, in fact, more robust models. So that's the important thing, and typically about what we experienced over the last 10 years. We have to notice that the markets in credit are quite different from a region to another. And especially, we believe in regional factors, meaning that there is no global factors. When we are talking about a value factor, we are talking about a euro value factor or a US dollar value factor, and not on a global one. And that's how we apply it also from time to time. And it's true also for momentum factors. Of course, as we're talking about systematic strategies, we have to take into account some operational constraints, which are about market liquidity, because applying a model in credit is a little bit different from applying it in equity. And so you have to control your liquidity cost of trade and the cost of trading. And you have also very often to apply a turnover control, because, for example, if you let the momentum factor completely free, you will have a turnover of around 400% a year. So meaning reshuffling the portfolio 4 times, which is, of course, too costly in terms of trading. And you have also to look at market events, because bonds are not like equity. They have a birth, they have a death, and so, or a maturity. We have to deal with what happens on the primary market. That's important to rebalance the factors from time to time and to benefit from also this excess premium you can catch on the primary market. And you have also to manage the potential credit deteriorations that you can see through rating downgrades, because very often when we launch a fund or a strategy, we can have constraints on rating. It's not the same thing to propose an investment grade strategy or a crossover one or high yield. And there are also some special events like corporate actions, when the bonds are reshuffled a little bit, renegotiated by issuer with sometimes the new covenants and so on. So how we build a multi-factor strategy? So as I said, on corporate bonds based on value factor and momentum factor. What we call a value factor, in fact, is a way to estimate the difference between the intrinsic value of the bonds and its relative value in the market. It is important to notice that for us, we are talking about this relative value. We are not talking about intrinsic value. It is not a Merton model adapted to corporate bonds. And we do not use data which come from other market than credit market. So we rely only on market which has on data which have the same frequency in terms of update as the market, and so which are completely in line with the price evolution. Our value factor means that for each bond, we want to compute a theoretical spread based on market data, and then to compare it to the observed spread. And so this distance gives you the value signal. So the higher is the distance, the more important the value is in the market. And so that's how we build this value factor, by picking, in fact, the bonds with the higher value signal. So the spread is explained through an econometrical model by characteristic of the bonds and market data such as spreads and prices. So here you will see in page 19 a description of this model and how, in fact, we compute it. The main characteristics we use are the classical one, which are analyzed by all the market practitioners, which are very easily the rating, the sector, the country risk, the seniority, as we have more and more subordinated bonds in the market, face value, maturity, and of course optionality, because you have more and more callable bonds in the market. As I said, the difference between the observed spread and the theoretical spread coming from the model gives you the value potential. Of course, from a bond to another, there will be a different explanation of the value potential. And from time to time, it will be more linked to sectors or seniority, or sometimes to region. Of course, after the first step of the estimate, we have to build a real factor. So for that, we keep the first top 100 bonds with the value potential, and we skip out the first 10 bonds. Why? Because in the value factors, there is very often what we call the value trap, which are the bonds which are in fact undervalued by the market, but for good reasons. And very often that's sometimes a leading indicator of a potential downgrade or even default or credit event. That is why, statistically, to avoid to be trapped in this value trap, we exclude the 10 first bonds from the value factor. So the value factor is in fact the 90 bonds resulting from that process. We equally weight those bonds to avoid to have a too important jump to default risk, meaning that the exposure to credit event is equally weighted on the factor. And we rebalance it on a monthly basis. Of course, as I said, we have to constantly monitor this factor because we have to be reactive if there are some corporate action or if there are some primary bonds coming in the market. On the momentum factor, it's quite straightforward. Like for the sovereign bond, the momentum factor is the way to be long the performers and short the underperformers. As we are talking here about corporate cash bonds, we are not talking about a long-short momentum factor. We are talking about a long only. We will only buy the performers, which are represented by the bonds which exhibit the best performer over the 6 months trading excess return. So that's how we do it. And of course, we scaled it by spread duration to avoid to be biased towards the long maturity bonds. What is interesting is that the momentum factor is really complementary to the value factor. Here you will see the payoff of the two strategies. On the left side, this is the value strategy. On the right side, the momentum strategy. In fact, what we can see is that the momentum factor in the natural market environment does not perform a lot. It does not destroy value, but it is not very performing. But what is interesting is that if we go into bad performance territories on the credit market, then the momentum strategy posts good performance. So which means that if you apply in a multi-factor strategy a combination of the value factor and the momentum factor, then you have an interesting payoff as a combined strategy, which is the one we have on this slide. So meaning that, of course, you will not earn money at any time, but it means that in terms of bearish time, in a bearish period in the credit market, you will mitigate the loss you could have on the value strategy by the gain you will benefit from the momentum strategy. So the momentum strategy is a quite good edge, interesting one, and not very expensive for a portfolio. That is why we, in our multi-factor strategy, in fact, we combine these two factors with a relative weight, which gives enough protection to the value factor. Because the value factor is interesting, but has a big bias, which is a high beta exposure. So meaning that the value factor, in fact, is a sort of smart high beta strategy. Of course, we could constrain it, but we think it's more interesting to benefit from that, to be transparent, and to control it. So that's how we can benefit from positive risk premium by the combination of alternative factors in corporate bond world. Of course, once again, it's not a magical point. As you can see, you are long credit risk. The only difference is that you are not just long credit beta. By using this alternative factor, your reaction will be, or the reaction of your portfolio will be a little bit different. And so that is a good complementary to traditional bond investment, long-only bond investment. Here I talked about long-only alternative factors. We could also design long-short alternative factors, but of course, if we do so, we cannot rely on the bond market because shorting a credit bond is very expensive and quite complicated. If we do so, we will use CDSs, so credit default swaps, but that's another story. If we want to do that, we have to recompute our factors based on CDS market data, not on the bond market. That is very important that at every time when we are talking about quant strategies and systematic one, we need to be very careful on the adequacy between the data we use and the strategy we build. That is why, once again, at Amundi, we do believe that corporate bond alternative factors and more than fixed income factor investing must rely on data that comes from the fixed income market and not from other markets. Yeah, I think I went through the whole presentation. I'm sorry that this presentation on the think tank is done virtually, and I would prefer to be with you and physically present. I hope it will be done next year, and I wish you all the best in this uncertain time. But once again, facing uncertainties, we have to think more and to innovate more. And that's what the factor investing can bring, I would say, for our traditional investments.